Hi, I'm Lindsay Alexander, and this is mybanktracker.com. Money is a necessity. People may have to, at some point in their lifetime, borrow money for a huge investment, such as a house. This is also true for companies and even the government to borrow money to help make their business grow. That requires large sums of money that even a bank will not be able to give them. So this is where bonds come into the picture and are issued to the public. An issued bond allows thousands of investors the ability to provide the company or government entity the capital it needs to expand. Typically, the investor of the bond is really a lender of money to the company who's referred to as the issuer. The issuer must give the investor something in return for the use of their monies. Interest payments are then returned to the investor. These payments are made at a rate and scheduled, which is predetermined at the time the bond is issued. The interest rate on the investment is known as a coupon. The designated date when the issuer must repay monies borrowed is referred to as the maturity date. Bonds are called fixed income securities. This term is used because the investor knows exactly how much cash they'll receive back if the bond is held until its maturity date. Over a period of time, you'll receive interest payments for the set amount of time. When the bond has reached its maturity date, the investor will then get their full amount of investment back. Bonds are considered a debt, but stocks are not because it's more of an equity and it's important that the investors will become part owner in their business. This actually gives the investor the right to vote and share on profits of the company into the future. And investors that purchase a bond will not own part of the company, but will become a creditor of the company. By purchasing the debt of a company, the investor has more claim rights on company assets than a shareholder would. And investors will not share any profits the company makes. However, in the event of a bankruptcy situation, creditors will get paid before shareholders are able to collect. Bonds are considered to be a less risky investment strategy than purchasing company stocks, while in return may be lower for bonds. There's less worry about getting back all that money that was invested, and on top of that, the interest as well. Bonds are actually a good option for diversifying investment portfolios when also investing in stocks and other vehicles. Because they're lesser risk, they're a stable way to earn an extra investment income while still being able to take some risks with other investment types like stocks. The returns with bonds will be lower, but their predictability makes them easy to work within your overall investment portfolio and investment strategies. I'm Lindsay Alexander with mybanktracker.com, and together we're going to build your finances and rebuild the world.